Good morning. I'm Tim Nyland, and today I'm going to discuss one of the most important factors in building out your analytical framework for analyzing stocks, and that is how to perform quick and effective margin analysis. Each time I do a piece on margin analysis, I receive questions on how I was able to arrive at a particular conclusion so quickly. This is a very important skill to master when confronted with a stock you are not familiar with, or when you're bumping through a list of, say, 25 to 100 potential buy-sell candidates. It's even more important during periods of time like the upcoming earnings season when we are looking at so many companies approaching peak margin cycle, and we need to understand if the latest reported numbers are triggering a trend reversal or not. With everything else on your plate, the last thing you have time for is fumbling through financial statements trying to determine revenue growth versus cost trends. Before we get started, please like, comment, and subscribe, and come back every week for more videos on investing strategy and making the most of Zacks Pro platforms. If you'd like to do the kind of analysis you're going to see in this video, then you need to have a ZAT Portfolio Manager subscription, which includes both Zacks Advisor tools and the Zacks Research System. Let's go ahead and get started. Last week, we discussed the long-term analytical framework for approaching a Zacks rank of sell. We did so by looking at two completely different companies, Taiwan Semiconductor and Dollar Tree, completely unrelated industries, completely unrelated sectors. And both of them had Zacks rank sell ratings at the time. I introduced the three fundamental drivers of the Zacks rank of sell. This could be any Zacks rank. This is revenue growth and expenditures. Specifically, I split up expenses between capital expenditures and operating expenditures and spoke of the differences and significance of each. What I didn't tell you last week is that the three fundamental drivers of the Zacks rank are also drivers of margins, and that's what we're going to talk about today. So again, from last week, just very quickly, on the screen, I have the summary standardized financial statement, specifically the income statement out of the Zacks Research System. And I just wanted to briefly review for Dollar Tree the significance of the format of these financial statements. Again, this is a financial statement that I designed years ago to make margin analysis very simple. And what I want you to pay attention to are these indented rows. So you'll see that we have revenues, the main drivers here, revenues, gross profit, EBITDA, EBIT, pre-tax, net income, reported, and then net income adjusted. When you transform these financial statements to common size, I want you to notice that everything converts to a percent of revenues on the income statement. If you were to switch to the balance sheet, it would be a percentage of assets. Okay, so now we're able to look at actual gross profit margin percentages at every line item with EBITDA as well, EBIT margin, pre-tax margin, net income reported margin, and a net income adjusted margin, right? So you've literally got a complete window into full margin analysis and looking at these financial statements very quickly. What I want you to pay attention to is the difference between revenues and gross profit is cost of goods sold. The difference between gross profit and EBITDA margin is whatever expenses occur at the SG&A and R&D level. The difference between EBITDA margin and operating margin is your depreciation and amortization expense, generally speaking. The difference between your operating margin and your pre-tax margin is going to be the addition of the non-operating income and expenses and interest expense. So just knowing where these line items exist in the financial statement, you're able to quickly determine what the drivers of each of the different margin trends are. And you can see a specific trend here where we had a decline in gross profit margin when we actually had an increase in EBITDA margin and operating margin. And recall that from last week's webinar, we were able to quickly determine that we had an increase in cost of goods sold. And you can actually see that here, that was driving gross profit margin down when compared to the year ago quarter. Keep in mind, this is a single point in time, quarter over quarter annual comparison, right? So the idea is we can see that cost of goods sold represented 70.6% of revenues here, and it was actually represented less revenues here, 69.5, which yielded higher gross profit a year ago than in this particular current quarter, okay? We can also see that the company was able to cut selling general administrative expenses. They really don't have any R&D, the Dollar Tree. So it was that cut in SG&A from 24.6% of revenues down to 23 that actually yielded that EBITDA margin to increase to 9.1, okay? So again, this is the thought process, and we're going to review several companies today, and we're not going to look at financial statements, but I'm going to speak to these particular line items and identify what's going on with these trends using charts, okay? Note again from last week that we were able to quickly determine through the Zacks analyst research itself that in fact it was the cost of goods sold impacting those gross margins, and it was because of higher freight costs, so shipping costs. The interesting thing to note is that we were again able to back this into the actual second quarter earnings release, and we actually had a quote from the CEO, which is actually put in the Zacks analyst written research as well. Said the company expects higher freight costs to persist through fiscal 2021. So that was as of several weeks ago. And interestingly enough, we're going to talk about some Wall Street Journal articles here in a minute where the CEO has since revised that statement. Now it's not through just fiscal 2021. These cost pressures from shipping expenses are expected to be an issue throughout all of 2022. Okay, and this is why this is important. So last week's webinar, if you missed it, I've got it circled here in red off of our channel. Why a Zacks rank sell doesn't always mean dump it. And we introduced this concept of more or less margin analysis, and we're going to elaborate on it today. So here's one of the articles that I mentioned that we'd be looking at. This was actually in the journal last Wednesday, and I read it right after I recorded last week's webinar. And this caught my attention because this is a 25% price increase that's going to take place for artificial Christmas trees this year. And specifically, they interviewed the CEO of Balsam Hill, which is kind of a premium artificial Christmas tree manufacturer. Their trees pretty much start at $1,000 and kind of go up from there. But the interesting point here is that they refer to shipping costs as skyrocketing, and I have that here in highlighted in yellow. I'm not going to read the whole thing, but it is saying that U.S. retailers are expected to raise prices between 20 and 25% to keep pace with skyrocketing shipping costs, okay? The most important part of this article and what really drove this week's webinar, really convinced me to actually do this week's webinar, was this second highlighted quote down here. And this is from the chief executive officer of Balsam Hill. He said, "We've never raised prices anywhere close to that in our history, and we'll make less money." Okay. So when you hear that, the very first thing that clicks in my mind is margin erosion, right? We've never raised prices anywhere close to that in our history, and we will make way less money, not just less money, but way less money. We've got margin erosion here, folks. So this caught my attention. I cut it out. This is from Wednesday's Wall Street Journal. And then on Friday, 9/17, just 2 days later, this is Friday of last week, right on the front page of Business and Finance, the Wall Street Journal, shipping costs add to pricing pressure, right? So they interviewed executives from several companies, and I just highlighted a few in here. From Joanne Stores, it was interesting. Sometimes the ocean freight now is actually more expensive than the cost of the product. I mean, this is kind of shocking. And interestingly enough, as we speak right now, they're estimating as of this morning that 20% of shipping container, I should say cargo ships that are hauling shipping containers in the Pacific Ocean are literally just in a standstill waiting for ports to clear. So we've got a huge bottleneck in China, and we've got a huge bottleneck in LA, Long Beach. So we've got 20% of container ships just literally sitting idle out in the Pacific Ocean. So they basically interviewed the CEO of Dollar Tree again. This is where he went back and said that we are not counting on a material improvement in 2022. So taking and pushing back that forecast for recovery in shipping costs, not through just 2021, but all the way through 2022. Same thing with Mondelez. Freight costs and commodity and transportation costs higher than expected. And Proctor and Gamble, right, an earnings certain name, has announced several price increases for products, citing commodity cost increases and the cost of freight. Okay, so we're going to look at all three of these companies, and I'm going to show you exactly how to how to cut through the noise and determine exactly what's going on with margins. So in the case of Dollar Tree, what we're going to do is we're going to shift our analysis of looking at quarter to quarter annual trend, and we are going to look at a trailing 12-month. And the way I want you to do your margin analysis is this particular chart on the screen. You need to look at it in a 4-panel chart, and you need to convert your revenues to a 1-year percent change. And below that, you're literally just going to mirror the income statement. So it's going to be revenues minus cost of goods sold is going to give you your gross margins, right? And then you're going to have your SG&A and your R&D. And we're not going to go through the EBITDA exercise. We're going to go straight to operating margins from gross margins. So that's going to include depreciation and amortization as well to get down to operating margin. And then you're going to have your non-operating income and expense and interest expense between operating margins and net margins. So you've got an entire income statement's margin presentation sitting right in front of you in chart form. And what we can conclude very, very quickly just by looking over at the right, and I've got the trends that I want to focus on here circled in red for you. Keep in mind that I always like to look at a 5-year chart to get good scaling in this view when you're looking at the most recent points. And then once you have a grasp of the actual scaling and the direction that these margins are moving, then you pull it out to a 10, 15, and 20-year chart to look at the overall business cycle for the particular company. We're not going to do that in this webinar. I'm going to focus on these trends here. And what I want everybody to see right out of the gate is this gross margin decline, right? We already knew that. We've spoke of this, right? We know that Dollar Tree is having problems with their shipping costs, and it's leading to a gross margin erosion. But what you didn't necessarily know is that the revenues on a trailing 12-month have actually trended down as well. So obviously, Dollar Tree was not able to pass along those increased shipping costs as their revenues were trending down, okay? That obviously led to the gross margin decline. The interesting thing enough here, though, is that we see that we've got an increase in operating margins, right? So that tells me right away, with no R&D expenses for Dollar Tree, that Dollar Tree was able to cut their SG&A expenses as a percent of revenue to more than offset the increase in shipping costs that resulted in that increase in that operating margin that we're looking at right here, okay? So we've got shipping costs eroding gross margins. The company masterfully turned around and said, okay, we can't pass along those costs. We've got to make cuts. They took it out of selling general administrative, and they actually more than offset it to increase their operating margins. And interestingly enough, I have all this outlined down here below. You can see that their net margins were actually able to remain stable throughout this process, okay? So how does that work? Well, we had a slight revenue decline, we had a gross margin decline, and then they were able to cut enough selling general and administrative expenses to offset all of these such that their net margins were able to remain stable, okay? So they're able to protect their bottom line, and we see this regularly, especially with earnings certain stocks. Remember that Dollar Tree is a member of the earnings certain portfolio, and these executive teams are masterful at managing that earnings trajectory, if you will. And so the question we need to ask ourselves, right? It's one thing to do the margin analysis. What we need to do is make sure we're asking the right questions when we're done. Is how long can Dollar Tree continue to cut costs to offset those shipping expenses to stabilize those net margins? And the answer is obviously they're ultimately going to need to grow revenues to stabilize this net margin if these costs continue to rise, because you can't continue to cut selling and general administrative costs forever, right? We know that. It's like squeezing blood out of a turnip. You just can't do it. You certainly can't do it forever. Okay, so that's how you read the margin trend for Dollar Tree. And remember that this is all based on trailing 12. And remember to transform your revenues to a 1-year percent change series when you're stacking them up against the actual margin line items. Then we'll move on to Mondelez now. Mondelez is the old Kraft. We've got a completely different scenario playing out here. With regard to Dollar Tree, remember we had revenues trending down. In this case, we've got revenues trending up, and we've got gross margins that are stable. And we know that Mondelez has experienced an increase in shipping costs because we read it in the Wall Street Journal article. We read the quote from Friday's journal last week. And so what this is basically telling us is because they were able to keep their margins straight or flat or stable, as I like to say, that Mondelez was actually able to pass along 100% of the increase in shipping costs to consumers. And that is what literally drove this stabilization in gross margins, okay? So the question is, how much longer can Mondelez continue to do that, right? The interesting thing here is that we actually had operating margin slippage. So it's interesting that this is exactly the opposite of what we saw with Dollar Tree. In this case, Mondelez experienced an increase in SG&A expenses as a percent of revenue. And again, if you look at the income statement on Mondelez, there's really not a lot of R&D expense, if any. So the bulk of this expense is related to SG&A. And so as a percent of revenues, right, this increase resulted in this operating margin decline, right? So they had an increase in revenues. They were able to pass off all of the shipping costs to stabilize gross margins. However, their operating margins sank because SG&A increased. And the interesting thing enough is that Mondelez's increase in revenue growth was not enough to offset the decline in operating margin, which resulted in a net margin decline. So again, without even looking at the income statement itself, you can look at this chart and see exactly what is going on, right? We know that we need more revenue growth out of Mondelez if it's going to offset what's going on with selling general administrative expenses. So the question we need to ask of Mondelez is, with operating margins and net margins already rolling over, what would happen to overall margins if revenue growth actually began to slow at the same time, right? So even with this type of a revenue growth trajectory, we're still getting operating margin and net margin rollover, even though we've stabilized gross margins. It would not be a good thing now if revenues actually turn the other way. That would actually lead to a negative compounding effect as we move down the income statement. And this is due to the fixed cost nature of a lot of these line items, right? Operating margin erosion could accelerate, and certainly net margin erosion would accelerate. Okay, so these are the things we need to be thinking about as we're looking at these margin charts. And this analysis should only take you a matter of seconds. When you look at these charts, you can see exactly what's going on. The more practice you get at this, the quicker, obviously, it becomes. Proctor and Gamble is the last stock we're going to look at. And again, this one is a little bit different scenario. They're all different, right? They're all going to be different. And that's the reason why we're looking at three today. And again, I literally just randomly picked three out of last Friday's Wall Street Journal article to show you how this works. So Proctor and Gamble, keep in mind, this is another earnings certain portfolio stock, right? You can see here that gross margins, again, on the decline with revenue growth trending up. So this is a similar scenario that we've talked about, right? When you see this, you automatically know that Procter and Gamble was not able to pass along the full 100% increase in shipping costs. And I think Procter actually said commodity costs as well to consumers. And that yielded this gross margin decline, okay? On top of the gross margin decline, Procter and Gamble also experienced an increase in SG&A expenses as a percent of revenues, which yielded additional operating margin decline. So even though revenues are trending up, Procter and Gamble is citing cost pressures, not only from shipping and commodity costs, but they've also got SG&A issues. And you can see this by simply noticing that they're at the high points right here. So 51.57 minus the 51.25, 24.78 minus the 24.13. These basis point spreads are much higher on the operating margin side. So we've got this compounding effect trickling down. So we've got gross margins taking a hit, but operating margins taking actually a larger hit. And that's due to the SG&A slippage as well, okay? So when we look at net margin declining, what again that tells us is that even though we had an increase in revenue growth, it was not enough to offset the increase in shipping and commodity prices, as well as the increase in SG&A, and therefore net margins slipped. Okay, so the question we have to ask with Procter and Gamble is with gross operating and net margins already rolling over. Again, this is something that we don't want to see. What would happen to basically the overall margin picture if that revenue growth began to slow at the same time? So very similar to the question that we had of Mondelez as well. And obviously the answer would not be good, right? The margin erosion would accelerate the further we go down the income statement. That is simply due to the fixed costs associated involved with many of those line items. Okay, so that's how you quickly utilize this particular chart out of the Zacks research system. And again, I like to look at a 5-year chart for scaling purposes. Once you've figured out what's going on with the trend, then you need to look at a 10-year, 15-year, and even a 20-year to see where they're at specifically in their longer-term margin cycle, right? The margin cycle itself speaks to the business cycle, and it's this business cycle that literally drives the market between recessions, right? That's why margins are important, and I'll show you why here in just a minute. Margins for me are the focus of literally every earnings season, and they should be for you as well. The question is, how do you monitor this? And the easiest way to do this is to utilize the weekly sector market earnings trend report. This report will help you stay on top of all of the latest sector and aggregate level trends in both top line versus bottom line beats and misses. So that's going to be all your revenue forecasts as well as your earnings forecasts. Remember, when you're talking about margins, it's all about revenues and costs, right? When you put those two together, you literally end up at net income. So when we're talking about earnings season, it's all about revenue forecasts and EPS estimates. Shiraz Mian is the one who puts this report together. It's available weekly, and it is absolutely tremendous. And we literally get a new report published each week. And if you do nothing else, just read it for the weekly summary of the key points on the main page. And I actually have a small excerpt of it here so you can see what it looks like. If you're an Advisor Tools subscriber, you have access to this report anytime you want it. And again, it's under market strategy, sector, and market earnings trends. If you're not an Advisor Tools or a Research System subscriber, we'll go ahead and email you a copy of our latest issue. Just go ahead and click in the link in the description below this video on YouTube, and we'll get that out to you right away. So this is a really, really good report because it literally serves as kind of your playbook. And especially when you're talking with clients about what's going on in terms of trend, you'll get a client call you up on the phone, hey, what's going on with earnings season? Kind of where are we at? How are things stacking up? Shiraz literally gives you the key points every single week, the trends. As these companies are reporting, he's literally got the score. So check it out. It's got some great tables, all the trends based on all the Zacks sectors. It talks about S&P 500, the small caps as well. I think you'll find tremendous value in that. So why is this so important right now? And why am I stressing it for this upcoming earnings season? A few webinars ago, we talked about the S&P 500 entering into that next phase of growth. Really, the entire economy is, right? So this is what we call that mid-cycle normalization. And I called this out months ago when I first started seeing these EPS estimate forecasts for 2021 really start to take a dip for 2022. In other words, the analysts started really, really reining in their estimates for 2022 and 2023 growth. And you can see that here in this estimate percent change table that's at the middle section of the price and earnings chart out of the research system. We go from 44% to 9% to 10%. And although you can't see it in the price performance of the S&P 500, we're getting a taste of it now. We're getting our first little correction that we've had in quite some time. When you peel back the layers of the onion and you split out the 200 cyclical names out of the S&P 500 like I did, and exclude the financials, I exclude energy. This is one of the portfolios that I utilize to back into the earnings certain portfolio. This particular cyclical portfolio that I use, the ZCYCE, is the actual composite symbol in the research system. This portfolio is 200 stocks of your most cyclically sensitive industrial names, in more or less in the S&P 500. And you can see the point of this portfolio is to exacerbate those economic cycles. And the reason why we want to do it is so that we can see these trends, right? It's kind of like bringing a microscope into the cyclical basket. You just don't see it in the S&P 500. You see it with this portfolio. And this is when I started making the call, and I actually started making the call back in May. You can see we actually topped in May. We've been sitting flat. Now we're on the decline, okay? So 2021, you can see 92% growth, and that actually falls all the way down to 8% and 10%. So it's a much different picture than you see for the broader S&P 500. There's a lot of growth names in here that are protecting it, right? So we're only going from 44 to 9 to 10. The real picture is 92 to 8 to 10. The reason why this is important, and we have to keep a pulse on these cyclical names, right? Remember, these are the 200 stocks that are the most sensitive to the economic cycle. The reason this is important is, again, we go back to margins, right? Cyclical stocks are rapidly approaching cyclical margin peaks. Remember, I told you that margins are cyclical, and we need to watch for any signs of margin rollover. Notice how fast we have entered into this mid-cycle recovery phase. I mean, we have literally ripped through this recession. This has been the fastest recession we've ever had and the fastest recovery I think we've ever had. And we are already mid-cycle, approaching cyclical peaks in terms of revenue growth. Normally, we don't hit this for, a year and a half in. I mean, we're only literally 6 months in here, maybe 8 months in here, and we're already hitting it, right? We're getting close. So just keep your eyes. Once we actually cross this 7.8%, this can happen very, very quickly. So we're approaching these cyclical highs, and we need to be careful. We need to watch this stuff. Okay. Once we start losing control of the revenue growth, once those cyclical names begin to roll over, we get margins rolling over, and then you can see how this works, right? You can see how we trend into more of the maturity phase of the recovery cycle. And this can go on for years. Again, we just need to be aware of it. Okay. So the conclusion here is that we never want to take our eyes off the margin trends. So the first point, and I've said this many times in this webinar, margins are cyclical. And the levels of margins are not as important as the trends, okay? Now, if you're an analyst and you're putting together models, obviously margin levels mean everything. But from the work that we're doing and what our concerns are, we're more concerned with trend reversals and trend confirmations. We like to see gross margins stabilize. We don't like to see gross margins rolling over, right? We would like to see operating margins hit a peak and then stabilize, not roll over. So you get the idea. Point number 2, focus on the entire margin picture and what the picture is telling you about management's ability to grow revenues versus manage costs, right? I think I've made a pretty good point of that. Point number 3, don't overcomplicate your margin analysis, right? This should only take a few seconds per company. Get familiar with those summary standardized financials in the Zacks research system and be able to easily identify those line items contributing to the margin changes if you're having problems with the chart. Sometimes you will need to bump into those financials just to make sure that you're seeing the right momentum, say when gross margins and operating margins and net margins are all trending down. You might need a little bit more clarity as to whether you've got multiple line items contributing to that or if there's just one or two. So point number 4, for Q3 earnings season, watch margin risk in both current quarter actuals and pay particular attention to the guidance, right, for further evidence of these ongoing supply chain hurdles. It's literally every day, right? We've either got the Fed telling us that they're being more and more surprised with inflation. I mean, this applies to inflation as well, right? Now it's the supply chain as well. We've got CEOs coming out just a couple weeks after they said they expect these supply chain issues to last throughout 2021. Now they're saying they don't expect to see much recovery in 2022. I mean, the question is, how long is this stuff going to last? And our best source of guidance is from these executive management teams during earnings season. So kind of read between the lines and pay attention to what their guidance is in terms of evidence for ongoing supply chain hurdles. Remember, as of this morning, literally 20% of cargo ships out in the Pacific Ocean are literally waiting to basically dock and unload their cargo. This could have major implications for the holiday season. All right. Remember, once these ships get undocked, they still got to transport the goods all the way across the United States, hit the distribution centers, you name it. It's a bottleneck for sure. Point number 5 is actually a good point, right? Demand remains strong. Demand is not our issue right now. It's almost purely supply side and what the Federal Reserve's next steps are. So there's plenty of stimulus in the economy to drive revenue growth during the next leg of the economic recovery. And obviously, revenue growth is the primary input to our margin analysis, right? It's the very first chart we looked at, that revenue trailing 12 one-year percent change. So point number 5, keep your eyes on the revenue growth. We want to make sure it's there. That is what's going to power us through to the next leg of the economic recovery. Point number 6 is we remain constrained by these ongoing supply chain hurdles. These are a real problem. They are pushing cost-driven inflation. I should say cost-push inflation, and they are threatening the rollover of corporate profit margins. Pay attention to this in the Q3 earnings season. You're going to hear many CEOs and executive teams citing the risk of margin rollover. We're seeing this now with Proctor and Gamble and Mondelez, and we might see it as well with Dollar Tree when they're no longer able to cut costs if these shipping issues are still a problem for Dollar Tree. So we'll want to pay attention to that. Okay. That's about it for this week. Thank you for attending. If you found this video helpful, please hit the like button below and be sure to subscribe for future videos. If you have any questions or ideas for future videos, please leave a comment below or email me at tnyland@zacks.com. You can also follow me on social media. I'm on LinkedIn and I'm on Twitter at Tim Nyland. If you're interested in getting started with Advisor Tools or the Zacks Research System, or if you'd like to request a copy of the slide deck, keep in mind that a lot of this margin analysis, I had all of what I was saying more or less noted at the very bottom of those 3 companies we looked at. Don't hesitate to reach out for the slide deck. Even if you're not a customer, we'd love to get those inquiries. We'll shoot you the slide deck over and you can have it for future reference. If you're looking to upgrade your current subscription or you have any other questions, just go ahead and contact our world-class support at advisortools@zacks.com and zrs@zacks.com. Thank you all for watching, and I'll talk to you next week.